Hey everyone, welcome back to John AG Expert. Gold has taken a serious hit. On Friday, it was at 5,040. Today, it's down to 4,862. That's a $178 drop in just 2 days. The $5,000 level is broken. Silver isn't looking great either. Futures dipped to $72.62, close to the lows from January 30th. If you're watching your gold or silver positions, you're probably asking the same thing. Is this the end of the rally? Or is it just a temporary dip caused by thin trading that will bounce back once serious buyers step in? In this video, I'm going to break down exactly why this crash happened, why $4,262 is such a key level, the three main forces that caused today's drop, and why tomorrow's Federal Reserve FOMC minutes could either save gold or push it even lower. This week isn't like any other we've seen so far in 2026. If you don't understand what's driving these moves, you could make the wrong decision at the worst possible time. Here's a quick reality check. About 75% of you watching aren't subscribed. If this honest, unfiltered look at gold and silver is helping you cut through the noise, hit subscribe. This channel is all about thinking for yourself, not following the herd. And right now, the herd is scared. If this video is helping you make sense of the market, drop John AG Expert in the comments. That's how I know it's landing. If it's not your thing, no worries. I'm here for people who want the truth, not just reassurance or doom. Now, let's go back to Friday, February 13th. At 8:30 a.m. Eastern, the CPI inflation report came out. Headline inflation came in at 2.4% year over year, slightly lower than the 2.5% expected. Core inflation was 2.5%, also lower than the 2.6% forecast. The market reacted instantly. Silver jumped from $74 to $79.35, and gold shot from $4,160 to $5,100 intraday, closing at $5,040. Rate cut hopes came back, the dollar weakened, and real yields fell to 1.86%. It was a textbook bullish day for precious metals. Everyone went into the weekend feeling confident. Then Monday hit. February 16th, President's Day. U.S. markets were closed, and much of Asia was either closed or on a half day for Lunar New Year. Shanghai, Hong Kong, Singapore, Taiwan, and South Korea all had limited or no trading. With the U.S. out for a holiday and Asia mostly closed, London opened with almost no support from buyers. Gold fell 1.5% to $49.67 before partially recovering by lunchtime. It was the first warning. Markets were thin, there were almost no buyers, and prices started drifting lower. So here's what really set the stage for gold to fall to 4,262. It wasn't just one thing, it was Now let's talk about what really could move gold and silver this week, tomorrow's FOMC minutes. The Federal Reserve will release the minutes from its January meeting on Wednesday afternoon. This is where we see what officials were really thinking about the economy, not just the public statements. Markets are already pricing in about a 79% chance of no rate change at the March 18th meeting. The first rate cut is expected in June 2026. Total cuts for 2026 are priced at roughly 2.5 cuts. The January CPI data showed inflation cooling. Headline, 2.4%, lowest since May 2025. Core, 2.5%, lowest since March 2021. This trend is dovish, meaning it supports lower rates. If the minutes reveal that the Fed is more concerned about slowing growth than inflation, or that they're considering more cuts, gold could bounce $100, $200 higher in thin Lunar New Year trading. That would push it back above $5,000, testing Friday's highs. On the other hand, if the minutes are hawkish, showing concerns about inflation or suggesting slower easing, gold could break below 4,137. In that case, the next target would be 4,960, and silver could test $70. In thin markets, that move could happen very fast. Analyst Ricardo Evangelista summed it up. FOMC minutes are probably going to be an important indicator for prices this week. Normally, minutes are just a secondary catalyst. But with China closed for 7 more trading days and thin liquidity, these minutes are now the primary driver. 3 scenarios for the week. Scenario 1, thin liquidity trap, 40% chance. Gold holds $4,862. FOMC minutes are neutral to dovish. Jobless claims Thursday support rate cuts. Hong Kong reopens Friday, confirming the bounce. China returns February 24th and resumes buying. Outcome, gold recovers to $5,050. The drop was just a temporary flush. Physical holders win, traders who sold regret it. Scenario 2, real breakdown 30% chance. FOMC minutes are hawkish. Gold closes below 4,937. Rising wedge pattern resolves downward. Next target, 4,760. Silver tests $70. China returns and sells instead of buying. Outcome, weakness confirmed. Traders capitulate and market moves lower quickly. Scenario 3, FOMC-driven recovery, 30% chance. Minutes are more dovish than expected. Officials push for 3 rate cuts. Gold bounces from $4,138 to $550, $5 to $100. Silver recovers to $77, $79. Outcome, thin liquidity now helps bulls, amplifying the rebound. Gold goes back above $5,000, setting up for a possible squeeze when China returns. No one can predict for sure. But this is the honest breakdown. 40% trap, 30% breakdown, 30% FOMC recovery. How different investors should react. Physical holders, do nothing. Fundamentals haven't changed. Gold targets from Jefferies, Goldman, UBS, and JP Morgan are still far above current prices. Futures traders, reduce position sizes by at least 30% if you haven't already. Widen stop losses below $4,160 since the next support is $4,160. If the short from $5,000 are wait for or higher, consider covering near the FOMC minutes. ETF or minor investors. GLD, SLV. Liquidity is better than futures, but spreads are wider. Mining stocks can move 3.5% on light volume. Add on weakness gradually, not all at once. Wait for FOMC confirmation before sizing up. Key numbers to watch tomorrow. Gold, 4,903 southern closing level. Silver, 72.62 intraday low. If these levels hold after the minutes, the structure remains stable. If they break, the market could move quickly to the downside. Now let's take a step back and look at the bigger picture. Today's $178 drop in gold and silver's pullback to $72.62 might look scary, but it doesn't change the fundamentals. Here's what's really happening. U.S. debt, 125% of GDP, adding $1 trillion every 90 days. Annual interest payments alone are $1 trillion. Deficits projected at $2 trillion per year for the next decade. China, 15 months of consecutive gold buying. Central banks bought 863 tons of gold in 2025. Silver supply, 6th year in a row with a deficit. COMEX inventory is down 39% since October. Industrial demand from solar, EVs, and AI is at record levels. Real yields, 1.86% and falling. Dollar, down 9% year over year, from 108 to 97. None of these trends changed because of thin Lunar New Year trading or the temporary optimism around Geneva talks. Geopolitical risks haven't disappeared. Iran talks could collapse tomorrow, and Russia-Ukraine negotiations are far from resolved. The key point, today's market move is a temporary disconnect between paper prices and physical reality. Thin liquidity exaggerated the sell-off. Wheaton's $4.3 billion silver deal today proves that serious buyers see prices much higher. What this means for you, physical holders, Stay calm. You bought gold or silver at $4,500, $4,800, or $5,000. The structural case for your holdings hasn't changed. Targets from institutions like Jefferies, 5,000, Goldman, 5,400, UBS, 6,200, and JP Morgan, 6,300 are still valid. Futures traders, reduce positions, widen stops, and don't get greedy below $4,900. Institutional bids appear quickly when markets are oversold. ETF, or minor investors, be cautious of volatility in GLD, SLV, GDX, and SIL. Buy in tranches, not all at once. Wait for confirmation from FOMC minutes. Everyone else, watch two key levels: gold at 4,1937 and silver at 72.62. Holding these levels means the market is just in a thin liquidity trap. Breaking them could signal more weakness. The bottom line, institutions are buying the dip and raising targets. Paper prices dropped due to thin liquidity and temporary optimism, but physical demand is real and strong. The only question is timing. When will the paper market catch up to reality? Invest with logic, not hype. Don't follow the herd blindly. Use your own research and judgment. At the end of the day, one thing is clear. Physical gold and silver will win over paper in the long run. Today's crash? Just noise. The real story is in the fundamentals. This week is a test of patience and understanding, not panic. Stay informed, watch the key levels, and remember, the paper market moves fast, but physical reality always wins eventually. John, AG Expert, out.